time. Ever wondered how traders use time-based charts to make decisions? Let's dive in and explore how these charts can be a powerful tool in your trading arsenal. Time-based charts are more than just lines and numbers. Steer a window into the market's heartbeat, showing you how prices move over specific periods. Imagine being able to see not just where the market has been, but where it might be headed. Time-based charts allow you to do just that. They track the price of an asset over set intervals, whether it's minutes, hours, days, or even weeks. This visual representation helps you spot trends, identify patterns, and make informed decisions about when to enter or exit trades. At the core of time-based charts are their key components, the time interval and the price data. The time interval is the constant measure on the chart, whether you're looking at 5-minute candlesticks or daily bars. Each bar or candlestick represents the opening, high, low, and closing prices for that period, giving you a snapshot of market activity in that specific window. Reading these charts effectively involves understanding the story they're telling. For example, if you see a series of upward moving bars, you're likely looking at an uptrend, a signal that buyers are in control. On the other hand, a series of downward moving bars suggests a downtrend, indicating that sellers are driving the market lower. But it's not just about the direction. The size of the bars or candlesticks also tells you about the market's volatility and momentum during that time frame. But the real power of time-based charts comes when you start using them in your trading strategy. By layering these charts with indicators like moving averages or Bollinger Bands, you can get a clearer picture of market trends and potential turning points. And with platforms like RTrader Pro, you can easily set up these charts, customize them to your preferences, and even set alerts to stay on top of significant market movements. So, whether you're a seasoned trader or just starting out, mastering time-based charts is a key step toward making smarter, more informed trading decisions. They're your guide to understanding market rhythms and taking action with confidence. Let's get started. Time-based charts plot price data at regular intervals, like every minute, hour, or day, offering a clear view of how prices evolve over specific periods. These charts are essential for traders because they provide a structured way to analyze market behavior. By observing how prices change over time, you can start to identify patterns and trends that offer clues about where the market might be headed next. For example, if you're looking at a daily chart, each bar or candlestick represents 1 day's worth of price action. You can see where the price opened, the highest and lowest points it reached, and where it closed by the end of the day. This visual representation helps you track the market's direction and momentum, whether it's steadily climbing, dipping, or moving sideways. The real advantage of time-based charts is that they allow you to spot trends more easily. When you see a series of rising prices over consecutive intervals, it suggests an uptrend, indicating that buyers are in control. Conversely, a series of declining prices points to a downtrend where sellers are dominating the market. By recognizing these patterns, you can make more informed predictions about future price movements and adjust your trading strategy accordingly. Whether you're trading in fast-paced environments or analyzing long-term investments, time-based charts provide the insights needed to understand market dynamics and make decisions with greater confidence. Let's break down the key components of time-based charts to understand how they work. The x-axis represents the time intervals, which could be as short as minutes or as long as days, depending on the level of detail you want in your analysis. This axis is your timeline, showing the progression of time as the market moves. On the y-axis, you have the price of the asset at each time interval. This is where you see the actual value of the asset, whether it's rising, falling, or staying relatively stable. The interaction between the x-axis and y-axis allows you to track how the price changes over time, giving you a clear visual representation of the market's behavior. By plotting these price points across regular time intervals, the chart begins to tell a story of how the asset's value evolves. For example, a steep rise on the y-axis over a short span on the x-axis might indicate a sudden surge in demand, while a gradual decline could suggest a slow but steady sell-off. Understanding these components is essential because it's through this combination of time and price that you can start to identify patterns, spot trends, and make more informed trading decisions. Whether you're examining the market over a few hours or several weeks, these charts give you the tools to visualize the past and anticipate future movements. Candlesticks and bars are the most commonly used formats for displaying price data on time-based charts, each offering a distinct way to visualize market movements. Candlesticks are particularly popular because they provide a comprehensive view of the price action within each time interval. Each candlestick represents the open, high, low, and close prices, encapsulated within a rectangular shape. If the closing price is higher than the opening price, the candlestick is typically colored green or white, indicating that the price moved up during that interval. Conversely, if the closing price is lower than the opening price, the candlestick is usually red or black, signaling a downward movement. This color coding makes it easy to quickly assess whether buyers or sellers were dominant during a particular period. The body of the candlestick, the space between the open and close, gives you an immediate sense of the price range during that interval. The thin lines, or wicks, extending above and below the body represent the highest and lowest prices reached during the time frame, providing additional context about market volatility. Bar charts, on the other hand, also display the open, high, low, and close prices, but in a slightly different format. Instead of a solid body, bar charts use vertical lines to represent the entire range of prices during the interval, from the low to the high. The opening price is marked with a small horizontal tick on the left side of the vertical line, and the closing price is marked with a tick on the right side. This format offers a clear, concise way to view the same information, but without the color coding that candlesticks provide. Both candlestick and bar charts give you a detailed snapshot of how the market is behaving over each time period, helping you to identify trends, reversals, and potential trading opportunities. The choice between the two often comes down to personal preference and how you like to visualize the data. Whether you prefer the visual clarity of candlesticks or the straightforward simplicity of bar charts, both formats are powerful tools for understanding market dynamics and making informed decisions. Volume is another crucial component of time-based charts that adds an important layer of context to price movements. Volume represents the total number of units of the asset that were traded during each time interval, providing insight into the level of market activity. High volume often suggests strong interest in the asset, whether it's buying or selling. For instance, if you see a price increase accompanied by high volume, it typically indicates that the upward trend is backed by significant buying interest, which could be a sign that the trend is strong and likely to continue. Conversely, if the price is dropping on high volume, it signals strong selling pressure, reinforcing the downward trend. Low volume, on the other hand, might indicate less interest in the asset. When price changes occur on low volume, they may not be as reliable because the movement could be driven by a smaller number of participants, making it more susceptible to reversals. For example, a price increase on low volume might not hold, as it lacks the widespread support needed to sustain the trend. Volume is particularly useful for confirming trends. If a trend is accompanied by increasing volume, it's generally seen as more robust and likely to persist. However, if volume starts to decline as the trend continues, it could signal that the trend is losing momentum and might be nearing a reversal. Volume spikes can also be a signal of potential reversals or significant market moves. For example, a sudden surge in volume after a prolonged trend might indicate that a reversal is imminent, as more traders are entering the market, possibly in anticipation of a change in direction. Incorporating volume analysis into your chart reading allows you to better gauge the strength of price movements and make more informed trading decisions. It helps you confirm trends, identify potential reversals, and understand the underlying dynamics of the market beyond just the price action. Now let's explore the different types of time-based charts, starting with the simplest, line charts. Line charts connect the closing prices over specified intervals, creating a continuous line that traces the asset's price movements. This simplicity makes trends easy to spot, as the line smoothly illustrates the overall direction of the market, whether it's trending upward, downward, or moving sideways. Line charts are ideal for getting a quick overview of price movements, helping you see the big picture without the distraction of too much detail. For those who need more information, bar charts offer a deeper dive into the price action. Unlike line charts, which only show closing prices, bar charts provide a fuller picture by including the open, high, low, and close prices for each time interval. Each bar on the chart is a vertical line representing the range of prices during that period, from the lowest to the highest. Small horizontal ticks on the left and right sides of the vertical line mark the opening and closing prices, respectively. This additional detail allows you to see not just the direction of the price movement, but also how volatile the market was within each interval. For example, a long bar with a wide range between the high and low indicates significant price swings during that period, suggesting higher volatility. In contrast, shorter bars with smaller ranges indicate more stable price movements. Bar charts help traders understand the nuances of price behavior over time, making them useful for analyzing the strength of trends, identifying potential reversals, and planning precise entry or exit points in trades. By providing a more comprehensive view of the market, bar charts enable you to make more informed decisions based on the full spectrum of price data, rather than just the closing prices. Candlestick charts take the detail of bar charts a step further, offering even more information in a visually intuitive format. The colored bodies of each candlestick make it easy to see at a glance whether the price went up or down during each interval. This color coding is what makes candlestick charts so popular among traders. It provides a clear, immediate sense of market sentiment. When you look at a candlestick chart, each candlestick represents a single time interval, and its body shows the range between the opening and closing prices. If the closing price is higher than the opening price, the candlestick is typically colored green or white, indicating that the price increased during that period. If the closing price is lower than the opening price, the candlestick is usually red or black, signaling a price drop. The wicks or shadows extending above and below the body represent the highest and lowest prices reached during that interval. These wicks give you insight into the price extremes and the volatility within the time frame, which can be crucial for understanding market dynamics. Candlestick charts are especially helpful for spotting potential turning points in the market. For instance, certain candlestick patterns, like dojis or engulfing patterns, can signal that a trend is losing momentum and might be about to reverse. By quickly grasping these signals through the color and shape of the candlesticks, traders can make more timely decisions whether it's to enter, exit, or adjust their positions. The combination of color, body shape, and wicks in candlestick charts provides a rich visual narrative of market activity, making it easier to assess market sentiment, gauge volatility, and identify key support and resistance levels. This depth of information, packed into a single chart, allows traders to make more informed and strategic decisions in their trading activities. Reading time-based charts effectively involves recognizing trends, support and resistance levels, and chart patterns, all of which are key to understanding market behavior and making informed trading decisions. Trends are fundamental to chart analysis as they reveal the general direction in which the price is moving. An uptrend is identified by a series of higher highs and higher lows, indicating that the market is gradually pushing prices upward, with buyers consistently driving the price to new peaks. This is often a signal of bullish sentiment, where the overall market outlook is positive. In contrast, a downtrend is marked by lower highs and lower lows, showing that sellers are in control and the price is steadily declining. This pattern reflects bearish sentiment, where the market is losing value, and traders might look to sell or short the asset. Then there are sideways trends, which occur when the price moves within a horizontal range, neither significantly rising nor falling. In this scenario, the market lacks a clear direction, with buyers and sellers in relative balance. Sideways trends often suggest consolidation, where the market is taking a breather before deciding on its next move. Traders might use these periods to anticipate a breakout where the price could move decisively out of the range in either direction. Support and resistance levels play a crucial role in trend analysis. Support is a price level where the asset tends to find buying interest, preventing it from falling further. Resistance is the opposite level where selling interest is strong enough to stop the price from rising higher. These levels often serve as decision points for traders, where a break above resistance might signal the start of a new uptrend, while a drop below support could indicate the beginning of a downtrend. Finally, chart patterns within these trends and ranges can provide valuable signals. Patterns like head and shoulders, double tops and bottoms, and flags can hint at potential trend reversals or continuations, offering traders opportunities to enter or exit trades strategically. By mastering the ability to identify trends, recognize support and resistance levels, and interpret chart patterns, you can read time-based charts with greater precision, helping you to navigate the markets and make decisions that align with the prevailing market sentiment and potential future movements. Support and resistance levels are crucial in understanding market dynamics and making informed trading decisions. These levels represent key price points where the asset's price tends to reverse direction, providing traders with valuable signals about potential entry and exit points. Support is a price level where buying interest is strong enough to prevent the price from falling further. When the price approaches a support level, it often stops declining and may even start to rise as buyers step in, viewing the price as a good buying opportunity. This makes support a critical level to watch when considering entering a long position, as it can indicate a potential price floor where the market might start to rebound. On the flip side, resistance is a price level where selling interest is strong enough to prevent the price from rising further. When the price reaches a resistance level, it often struggles to move higher and may start to decline as sellers take control, viewing the price as a good point to sell. Resistance levels are key when deciding on exit points for long positions or considering short positions, as they can signal a potential price ceiling where the market might reverse direction. Identifying these support and resistance levels on a chart helps traders anticipate where the price might change direction, allowing them to make more strategic decisions about when to enter or exit trades. For instance, if the price is approaching a known support level, a trader might choose to buy, expecting the support to hold and the price to rise. Conversely, if the price is nearing a resistance level, a trader might decide to sell, anticipating that the resistance will hold and the price will drop. Support and resistance levels also play a crucial role in setting stop loss and take profit orders, helping traders manage risk and lock in profits. By aligning trades with these key levels, traders can enhance their chances of success, making decisions that are informed by the natural ebb and flow of the market. Chart patterns are specific formations that price movements create on a chart, and they can provide valuable clues about future market behavior. By recognizing these patterns, traders can anticipate potential price movements and make more informed trading decisions. One of the most well-known patterns is the head and shoulders. This pattern typically signals a reversal from an uptrend to a downtrend. It consists of 3 peaks. The first and third peaks are smaller and form the shoulders, while the middle peak is higher and forms the head. When the price drops below the neckline, drawn through the lows of the shoulders, it often indicates that the uptrend is losing momentum and a downtrend is likely to follow. Traders might see this as a cue to sell or short the asset, expecting further declines. Another common pattern is the double top, which occurs when the price reaches a high point twice but fails to break through, forming 2 peaks at roughly the same level. This pattern suggests that the asset is struggling to move higher and could be preparing to reverse downward. When the price drops below the support level that lies between the 2 tops, it confirms the pattern, signaling a potential downtrend. Conversely, the double bottom pattern indicates a potential upward reversal. It forms when the price drops to a certain level twice, but fails to fall further, creating 2 lows at about the same level. This pattern suggests that selling pressure is weakening and buyers might soon take control. When the price breaks above the resistance level between the 2 bottoms, it confirms the pattern and indicates that an uptrend may be starting. Flags are another useful pattern, often seen as continuation signals. After a sharp price movement, the price may consolidate within a narrow range, forming a flag shape. If the price breaks out of the flag in the direction of the prior trend, it often signals that the trend will continue. By learning to identify and interpret these chart patterns, traders can gain insights into potential trend reversals or continuations, helping them make timely and strategic trading decisions. These patterns offer a visual shorthand for understanding market sentiment and predicting future price movements, making them a vital tool in any trader's toolkit. Now that we've covered how to read time-based charts, let's dive into their practical application in trading. One of the most popular tools for analyzing these charts is the moving average, which helps smooth out price data and make trends easier to spot. A moving average works by calculating the average price of an asset over a specific number of intervals, such as 10, 50, or even 200 periods. This average is then plotted on the chart as a line, creating a smoother representation of price movements that filters out short-term fluctuations. The real power of moving averages lies in their ability to help traders identify potential buy or sell signals. When you compare the current price to the moving average, certain patterns emerge. For instance, if the current price crosses above the moving average, it can indicate the start of an uptrend, suggesting a buying opportunity. Conversely, if the price drops below the moving average, it might signal the beginning of a downtrend, which could be a cue to sell. Traders often use different types of moving averages, such as simple moving averages (SMA) or exponential moving averages (EMA), depending on their strategy. A simple moving average gives equal weight to all the points within the selected period, providing a broad view of the trend. An exponential moving average, on the other hand, gives more weight to recent prices, making it more responsive to current market conditions. For example, if you're using a 50-day simple moving average, the line will show the average closing price of the asset over the last 50 days, updating with each new interval. If the current price rises above this 50-day average, it's often seen as a bullish signal, indicating that the asset is gaining momentum. On the flip side, if the price falls below the moving average, it could be a bearish signal, suggesting that the asset might be losing strength. Moving averages can also be used in combination, such as in a moving average crossover strategy, where a short-term moving average crosses above or below a long-term moving average. This crossover can provide further confirmation of a trend change, helping traders make more confident decisions. By incorporating moving averages into your trading strategy, you gain a powerful tool for smoothing out the noise in price data, making it easier to recognize trends and identify key entry and exit points in the market. Using a stop-loss market order is a crucial strategy for managing risk and protecting your investments. This type of order automatically sells your asset when it reaches a predetermined price, helping to minimize potential losses in case the market moves against you. Let's say you buy a stock at $100. To cap your risk, you decide to set a stop loss at $90. This means that if the stock price falls to $90, your position will be sold automatically, limiting your loss to $10 per share. By setting this stop loss, you're essentially creating a safety net that protects your capital from further downside. Stop loss orders are particularly valuable in volatile markets, where prices can change rapidly. Without a stop loss in place, you might find yourself holding onto a losing position for too long, hoping for a rebound that might not come. By the time you decide to sell, the price could be much lower, resulting in greater losses. A stop-loss order takes the emotion out of the decision-making process, ensuring that you stick to your predetermined risk tolerance. The beauty of a stop-loss market order is that it doesn't require you to constantly monitor the market. Once the order is set, it works in the background, ready to execute the sale if the price reaches your specified level. This allows you to trade with more peace of mind, knowing that your risk is managed even if you're not actively watching the market. In essence, a stop-loss market order is a simple but powerful tool that helps you stay disciplined and protect your portfolio from significant losses. Whether you're a seasoned trader or just starting out, incorporating stop-loss orders into your trading strategy is essential for maintaining control over your investments, especially in uncertain market conditions. To set a stop-loss order in RTrader Pro, start by selecting the asset you want to protect. Once you've chosen your asset, navigate to the Order Type menu and select Stop-Loss Order. Next, enter your trigger price, a specific price at which you want the stop-loss order to be executed. This simple yet powerful tool is designed to help you manage risk effectively, ensuring that your position is automatically sold if the market moves against you. By setting a stop loss, you can protect your capital and trade with greater confidence, knowing that your downside risk is capped according to your predetermined limits. Market limit orders are another valuable tool in your trading arsenal, providing you with control over the execution price of your trades. Unlike market orders, which execute at the current market price, market limit orders allow you to specify the exact price at which you're willing to buy or sell an asset. This ensures that your trade will only be executed if the market reaches your desired price or better. For example, let's say you want to buy a stock but are only willing to pay $50 or less for it. You can set a market limit order with a buy limit of $50. If the stock's price drops to $50 or below, your order will be executed at that price, ensuring that you don't pay more than you intended. This level of precision gives you control over your trades, allowing you to avoid unfavorable prices and stick to your trading strategy. Market limit orders are particularly useful in volatile markets, where prices can fluctuate quickly. By setting a limit order, you protect yourself from buying at a higher price during a sudden spike or selling at a lower price during a rapid drop. This way, you can enter or exit trades with confidence, knowing that the execution will align with your predetermined criteria. Whether you're aiming to buy at a specific entry point or secure profits at a targeted exit price, market limit orders offer a structured approach to achieving your trading goals. They help you manage your trades with greater accuracy, ensuring that you participate in the market on your terms without the need to constantly monitor price movements. Stop orders are an essential tool for managing risk in trading, as they trigger a trade when the asset reaches a predetermined price. These orders allow you to set specific exit points, helping you protect your investments from further losses in case the market moves against you. For example, let's say you own a stock and you're concerned about the potential for it to drop in value. You can set a stop order to sell the stock if its price falls to a certain level, such as $90. If the market price of the stock hits that $90 mark, the stop order will be triggered and your position will be automatically sold. This ensures that you exit the trade before the price drops even further, limiting your losses and preserving your capital. Stop orders are particularly valuable in fast-moving or volatile markets, where prices can change rapidly and unexpectedly. Without a stop order, you might hold onto a losing position for too long, hoping for a recovery that might not come. By the time you decide to sell, the price could be significantly lower, resulting in greater losses. A stop order takes the emotion out of the decision-making process, ensuring that your trade is executed according to your predetermined risk management plan. Incorporating stop orders into your trading strategy allows you to manage risk more effectively, providing a safety net that helps protect your portfolio from significant downturns. Whether you're trading stocks, commodities, or other assets, using stop orders ensures that you stay disciplined and maintain control over your investments, even in uncertain market conditions. Stop limit orders are a versatile tool that combines the features of both stop and limit orders, giving you more control over trade execution within a specific price range. These orders are particularly useful when you want to manage risk while also maintaining control over the price at which your trade is executed. Here's how they work. Suppose you own a stock and are concerned about a potential drop in its price. You can set a stop limit order to sell the stock if its price falls to $48. However, instead of selling at any price below $48, you set a limit of $47.50. This means that if the stock's price drops to $48, your stop limit order is triggered, but the trade will only execute if the price remains at or above $47.50. If the price falls below this limit, the order won't execute, protecting you from selling at a price lower than you're comfortable with. This strategy offers a balance between risk management and price control. The stop price ensures that your trade is triggered when the market moves against you, helping you avoid larger losses. Meanwhile, the limit price ensures that your trade only goes through at a price that meets your criteria, preventing you from accepting an unfavorable price just to exit the position. In volatile markets, where prices can fluctuate rapidly, stop limit orders provide the flexibility to set conditions that align with your risk tolerance and trading goals. They allow you to protect your capital while still having a say in the price at which your trade is executed, offering a strategic way to manage both risk and reward. By using stop limit orders, you can navigate market movements with greater precision, ensuring that your trades are executed on your terms. Advanced techniques can significantly enhance your trading strategy by providing a deeper, more nuanced analysis of market conditions. One effective approach is to combine multiple indicators, such as the Relative Strength Index RSI and the Moving Average Convergence Divergence MACD. Together, these indicators offer a more comprehensive view of the market, helping you make more informed trading decisions. The RSI is a momentum oscillator that measures the speed and change of price movements. It operates on a scale of 0 to 100 and is primarily used to identify overbought or oversold conditions in the market. When the RSI is above 70, it typically indicates that the asset is overbought and may be due for a correction. Conversely, an RSI below 30 suggests that the asset is oversold and might be poised for a rebound. By keeping an eye on the RSI, you can gauge whether the current trend has the strength to continue or if a reversal might be on the horizon. The MACD, on the other hand, shows the relationship between two moving averages of an asset's price, typically the 12-day and 26-day exponential moving averages EMAs. The MACD line is calculated by subtracting the 26-day EMA from the 12-day EMA, and it's often plotted along with a signal line, which is a 9-day EMA of the MACD line. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting it might be a good time to buy. When the MACD line crosses below the signal line, it produces a bearish signal, indicating it might be time to sell. By combining the RSI and MACD, you can achieve a more accurate and reliable analysis. For example, if the RSI indicates that an asset is oversold while the MACD shows a bullish crossover, the combination of these signals could strengthen your conviction to buy, as both indicators are pointing toward a potential upward movement. Conversely, if the RSI shows overbought conditions and the MACD signals a bearish crossover, it could reinforce a decision to sell or avoid entering a long position. This layered approach helps to filter out false signals and provides a more balanced view of the market's momentum and trend strength. By integrating multiple indicators into your analysis, you can improve the accuracy of your trading signals, reduce the likelihood of making impulsive decisions, and enhance your overall trading strategy. Customizing your chart layouts to highlight the most important data for your trading style is a crucial step in optimizing your trading efficiency. Trading platforms like RTrader Pro offer a wide range of customization options, allowing you to tailor your workspace to suit your specific needs and preferences. One of the key benefits of customization is the ability to arrange your charts in a way that makes it easier to monitor the markets and execute trades quickly. For example, you might choose to display multiple time frames for a single asset side by side, such as a daily chart, an hourly chart, and a 15-minute chart. This setup allows you to see both the big picture and the finer details at a glance, helping you make more informed decisions based on the broader trend as well as short-term price movements. In addition to chart layouts, you can set up watch lists that focus on the assets you trade most frequently. This feature allows you to keep an eye on multiple stocks, currencies, or commodities simultaneously without needing to switch between different screens. You can prioritize your watch list based on criteria like volatility, volume, or percentage change, ensuring that you're always aware of the assets that are most relevant to your strategy. Customizing your charts with indicators that align with your trading style is another critical step. Whether you rely on moving averages, Bollinger Bands, or specific oscillators, you can add these tools directly to your charts to enhance your analysis. For instance, if you focus on momentum trading, you might prioritize indicators like the MACD and RSI, placing them prominently on your charts to quickly assess market conditions. Furthermore, color-coding your charts and indicators can help you quickly interpret data and spot trends. For example, you could use different colors for bullish and bearish signals or for different time frames. This visual differentiation makes it easier to identify key information at a glance, reducing the time it takes to analyze charts and make decisions. By customizing your trading environment, you create a workspace that's organized, efficient, and tailored to your specific trading approach. This level of personalization helps you stay focused on the data that matters most, minimizes distractions, and ultimately improves your ability to react swiftly and accurately to market changes. Whether you're a day trader or a long-term investor, a well-organized and customized trading platform can make all the difference in executing your strategy effectively. Let's dive into some practical trading tips that can help you make the most of time-based charts. One of the most critical aspects of successful trading is effective risk management, and using tools like stop loss and limit orders is key to protecting your capital and minimizing losses. Stop loss orders are your first line of defense in managing risk. By setting a stop loss, you establish a predetermined exit point that automatically sells your position if the market moves against you. This prevents a small loss from escalating into something much larger, especially in volatile markets. For example, if you buy a stock at $100 and set a stop loss at $90, you've capped your potential loss at $10 per share, ensuring that your downside is limited. Limit orders, on the other hand, give you control over the price at which your trades are executed. When you set a limit order, you specify the exact price at which you're willing to buy or sell. This is particularly useful for entering trades at a favorable price or locking in profits when the market hits your target level. For instance, if you want to buy a stock but only at $50 or lower, a limit order ensures that you won't pay more than that, even if the market suddenly spikes. Having a solid risk management plan in place before you start trading is essential. This plan should include guidelines for how much of your capital you're willing to risk on each trade, the maximum loss you're willing to tolerate, and the levels at which you'll place your stop loss and limit orders. By sticking to this plan, you protect yourself from the emotional pitfalls of trading, such as holding onto losing positions for too long or chasing after quick gains. Incorporating these risk management tools into your trading strategy allows you to approach the market with greater confidence and discipline. Whether you're dealing with fast-moving day trades or longer-term investments, always using stop loss and limit orders ensures that you're trading with a safety net, helping you to safeguard your capital and achieve more consistent results over time. Continuous learning is absolutely vital for success in trading. The financial markets are dynamic, constantly evolving with new trends, economic developments, and global events. To stay ahead, it's crucial to keep updating your knowledge and adapting your strategies to fit the current market conditions. Staying informed about market news and trends is one of the best ways to ensure you're making well-informed trading decisions. Whether it's changes in interest rates, economic data releases, geopolitical events, or corporate earnings reports, these factors can significantly impact market behavior. By keeping a close eye on these developments, you can anticipate potential market movements and adjust your strategies accordingly. For example, if a major economic report is scheduled for release, it's essential to understand how it might affect the assets you're trading. If you're aware that the report could cause volatility, you might decide to tighten your stop losses, adjust your position sizes, or even sit out of the market until the news has passed. On the other hand, if a positive earnings report is expected for a company whose stock you're trading, you might consider positioning yourself to take advantage of a potential price increase. Beyond staying up to date with news, continuous learning also means refining your trading skills and knowledge. This could involve studying new technical indicators, exploring advanced chart patterns, or learning about different trading strategies. As the market changes, certain strategies that worked well in the past might become less effective while new opportunities arise. By constantly learning and adapting, you ensure that your approach remains relevant and effective. Additionally, learning from your own trading experiences is invaluable. Regularly reviewing your past trades, both successes and failures, can provide insights into what's working and what isn't. This self-reflection allows you to tweak your strategies, avoid repeating mistakes, and build on what you've learned. In a field as fast-paced and unpredictable as trading, complacency can be costly. Continuous learning keeps you sharp, helping you to navigate the markets with greater confidence and resilience. By staying informed, adapting to changes, and always seeking to improve, you set yourself up for long-term success in trading. Now, let's talk about some of the tools and platforms that can enhance your use of time-based charts, with RTrader Pro being a standout option. RTrader Pro is a robust trading platform designed for both novice and experienced traders, offering a range of advanced charting tools and real-time data to help you stay on top of the market. One of the key features of RTrader Pro is its ability to configure and customize time-based charts to fit your specific trading needs. Whether you prefer candlestick charts, bar charts, or line charts, RTrader Pro allows you to set up your charts exactly how you want them. You can adjust the time intervals to anything from minutes to days, depending on your trading strategy and the level of detail you require. This flexibility ensures that you can analyze the market with the precision and perspective that works best for you. In addition to its customization options, RTrader Pro provides the ability to overlay multiple technical indicators on your charts. You can add moving averages, Bollinger Bands, volume, and many other indicators to help you analyze trends and identify potential trading opportunities. The platform's intuitive interface makes it easy to adjust these indicators, allowing you to fine-tune your analysis in real time. RTrader Pro also excels in keeping you informed with its alert system. You can set up alerts for significant price movements, such as when an asset reaches a specific price level, crosses a moving average, or breaks through support or resistance. These alerts can be configured to notify you via pop-up, email, or even SMS, ensuring that you're always aware of critical market developments, even when you're not actively monitoring the platform. The real-time data provided by RTrader Pro is another major advantage. Accurate, up-to-the-minute data is essential for making informed trading decisions, especially in fast-moving markets. With RTrader Pro, you have access to real-time quotes, charting, and market depth, giving you the tools you need to react quickly and effectively to market changes. Overall, RTrader Pro is a powerful platform that provides everything you need to make the most of time-based charts. Whether you're analyzing trends, setting up strategic alerts, or executing trades, this platform offers the advanced tools and real-time data necessary to stay ahead of the market and achieve your trading goals. Setting up charts in RTrader Pro is a straightforward process that allows you to tailor your trading environment to fit your specific needs. Whether you prefer line, bar, or candlestick charts, RTrader Pro gives you the flexibility to choose the chart type that best suits your trading style and preferences. To start, you can easily select the type of chart you want to use. Line charts offer a simple, clear view of closing prices over time, making it easy to spot overall trends. Bar charts provide more detail by showing the open, high, low, and close prices for each time interval, giving you a fuller picture of price movements. Candlestick charts, with their color-coded bodies and wicks, offer a visual representation that makes it easy to identify market sentiment and potential turning points. Once you've chosen your preferred chart type, you can customize the time intervals to align with your trading strategy. Whether you're a day trader who needs minute-by-minute analysis or a longer-term investor focusing on daily or weekly trends, RTrader Pro allows you to set the time frames that provide the most relevant insights for your trades. Adding technical indicators to your charts is another powerful feature of RTrader Pro. Indicators like moving averages, RSI Relative Strength Index, and MACD Moving Average Convergence, Divergence can help you analyze price movements more effectively. For example, moving averages smooth out price data to highlight trends. RSI measures the speed and change of price movements to identify overbought or oversold conditions. And MACD shows the relationship between two moving averages to signal potential buy or sell opportunities. With RTrader Pro, adding these indicators is as simple as selecting them from a menu and adjusting their settings to fit your analysis needs. You can layer multiple indicators on a single chart, allowing you to view a comprehensive set of data points at once. This multi-faceted approach helps you make more informed decisions by providing a deeper understanding of the market dynamics at play. By setting up your charts in RTrader Pro with the right types, intervals, and indicators, you create a powerful tool for analyzing the market and executing your trading strategy with precision. The platform's intuitive design makes it easy to customize and adjust your charts, ensuring that you have the most relevant information at your fingertips as you navigate the markets. Alerts and notifications are indeed a valuable feature in trading, and RTrader Pro makes it easy to set them up to keep you informed of significant price movements. By configuring alerts, you ensure that you're always aware of important market changes, allowing you to act quickly when opportunities arise. Setting up alerts in RTrader Pro is straightforward. You can customize alerts to trigger based on various criteria, such as when an asset reaches a specific price level, crosses a moving average, or breaks through key support or resistance levels. These alerts can be tailored to fit your trading strategy, whether you're monitoring short-term fluctuations or waiting for longer-term trends to develop. For instance, if you're watching a stock and want to buy if it drops to a particular price, you can set an alert to notify you when the price hits that level. Conversely, If you're holding a position and want to be alerted if the price starts to fall towards your stop loss, setting an alert ensures you can react quickly to protect your profits or minimize losses. Our Trader Pro allows you to receive these alerts in various formats, including pop-up notifications, emails, or SMS messages. This flexibility ensures that you can stay informed even when you're not actively watching the market, giving you peace of mind that you won't miss critical movements. The ability to set up and customize alerts means you can maintain a proactive approach to trading rather than a reactive one. Instead of constantly monitoring the market, you can rely on your alerts to inform you when it's time to take action, freeing up your time and reducing the stress of constant market watching. This proactive alert system helps you stay ahead of the market and make timely trading decisions. Whether you're looking to capitalize on a sudden price movement or protect your position from unexpected volatility, setting up alerts and notifications in our Trader Pro is an essential tool for staying on top of the market and executing your trading strategy with confidence. As we wrap up, think about how you can apply these tips and techniques to your trading. What features are you most excited to try? How can you customize your time-based charts to fit your trading style? Thank you for joining us today. We hope this tutorial has been helpful and that you feel more confident using time-based charts. Keep learning, keep trading, and see you next